Good morning and welcome to our clients and friends. Thank you for joining us for today's professional education event entitled FASB Topic 842, What is the new lease accounting standard means for your organization? It's a very complex standard and we're happy to present to you today to help you work through this in your organizations. This 1 hour session is being hosted by Councilor Buchanan Mitchell, and I'm Julia Lafferter, partner and co-director of our nonprofit services. I am very proud to introduce today's speakers, Sally Hudson and Kathleen Booker. Sally is an audit manager at CBM with more than 10 years of experience managing financial statement audits and providing internal controls, consulting expertise to nonprofit organizations, governmental entities, employee benefit plans, and for-profit companies. Her audit experience includes conducting risk assessments, assessing internal controls, performing walkthroughs and tests of internal controls, and preparing financial statements and reports. She has advised several CBM clients on how to apply the new lease standard to their financial statements. Sally is a CPA and a certified information systems auditor. Kathleen Booker is an audit supervisor at CBM. She has years of technical accounting experience providing assurance and tax services to her clients in the non-for-profit sector. Kathleen also works with her clients, board members, and executive management to evaluate the design and implementation of internal controls and identify opportunities for strengthening operating efficiency. In addition to her client-related services, Kathleen is on the forefront of researching new accounting standards and hosting internal technical trainings to ensure her colleagues remain informed and is available to assist CBM clients. Kathleen is also a CPA. I have a few housekeeping items to go over with you. First of all, if you've submitted questions during registration, they have been incorporated by our presenters into these slides. And if your question is not answered, please just add it to the chat box during the presentation. Questions will be answered at the end of the session. We are offering CPE credit. 4 polls will be launched during the webinar. And I think we're going to launch a sample poll right now just so you can see what it looks like. And there you go. And then depending on the device that you're using, it will pop up on screen or potentially in your chat box. We will do our best to alert you that there is a poll to be answered. Please respond to 3 of them to get your CPE credit, and this one doesn't count. The session is being recorded, and within the next day or two, we will send you an email with presentation slides, a link to the recording, and the opportunity to send any follow-up questions to our presenters. Now I will turn it over to your presenters, Sally and Kathleen. Enjoy.
Great, thanks, Julia. To receive CPE credit, we have to go over the learning objectives here. And today, during the course, you should be able to understand the objective of topic 842, identify key definitions and practical expedients available, identify components of the right of use asset and lease liability, apply lease standard accounting principles to calculate amortization schedules and record journal entries, and understand topic 842's impact on the financial statement presentation and disclosures. Here's our course outline. I'm going to go over just a quick overview, go over some key definitions, some practical expedients your organization can adopt, go over the calculation of the new lease liability and right of use asset, go over the implementation steps. Kathleen's going to go over a great example for you guys, which will hopefully answer some of your questions. Go over the new journal entries you will be posting and any changes to your financial statements and disclosures. So why are we here? I've had so many clients ask me, why do they have to change this standard? And we're here because we're increasing the transparency and comparability among organizations by recognizing the lease assets and lease liability on the balance sheet and disclosing the key information about these lease arrangements. It's a greater impact to lessee accounting, and lesser accounting wasn't really changed. And for the purpose of this CPE, we're going to be focusing on the lessee accounting. And of course, the new difference is the recognition of the right of use asset and the lease liability on the balance sheet. We've been talking about this for years, it feels like, but it's finally here. The effective date for private companies and not-for-profits for fiscal years beginning after 12/15/21. So many of you are probably coming up on this with your year ending 12/31/22. And this applies to all leases and subleases of property, plant, and equipment. So when does it not apply? There are times when you might not apply topic 842. Leases with terms less than 12 months and the option to purchase is not reasonably certain to be exercised, also known as short-term leases, which we'll be talking about in a little bit. Leases of intangible assets, such as computer software, licenses, trademarks, patents. Leases of inventory, leases of assets under construction, leases to explore for the use of non-regenerative resources such as minerals, oil, natural gas, and biological assets such as timber. All right, we're gonna go through some key definitions you'll probably hear us talk about today. Topic 842 defines a lease as a contract or a part of a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Control means that the organization has the right to obtain substantially all of the economic benefits from the use of the asset and the right to direct the use of the asset. It must be an identified asset either in the contract or implicitly specified by being identified at the time the asset's made available for use. Lease term. This is the non-cancelable period for which a lessee has the right to use an underlying asset together with all of the following. Periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. Periods covered by an option to terminate the lease if the lessee is reasonably certain to not exercise that option. And periods covered by an option to extend or not to terminate the lease in which the exercise of the option is controlled by the lessor. So key words here are reasonably certain to exercise. This is important when determining the lease term. For example, if the lessee is not reasonably certain to exercise an option to extend the lease, then you're not going to use that extended date when you're calculating your ROU asset and the lease liability. A short-term lease. So this again is a lease at commencement date that has a term of less than 12 months, and it doesn't include the option to purchase the underlying asset, and the lessee is reasonably certain to exercise that. If you have short-term leases and you're not applying topic 842, then you must make this accounting policy and disclose it in your financial statements that topic 842 does not apply to short-term leases. And if this policy election is made, then you're going to recognize the lease payments on a straight line basis over the term and any variable lease payments in the period in which the obligation for those payments is incurred. The commencement date. The date on which the lessor makes an underlying asset available for use by the lessee. The timing of the payments does not impact the commencement date of the lease. It's the underlying asset may be available for use before the first payments due. Commencement date is important when figuring out the lease term. The lease term, also known as the non-cancelable period, is the time between the commencement date and the termination date. And Kathleen's going to go over this a little bit more with her example.
I want to add
You want to chime in,
too.
Kathleen?
Yeah, just for this. When we're talking about the commencement date, I just wanted to point out that you might actually literally see the words commencement date in your lease agreements. But when we're talking about the definition under 842, we're talking about when the asset is made available for use by the lessee. So there just might be differences in what that date is. And when you're applying 842, make sure you're looking at the 842 definition, not necessarily the date that's in your actual agreement. That's all.
All right, the discount rate. We are getting so many questions about, I don't know what kind of discount rate to use. There are three types of rates, and the first rate is the rate that's implicit in the lease. If your lease has an implicit rate, then you must use this rate. If it doesn't, then you can use the incremental borrowing rate, which is the rate the lessee would have to pay to borrow on a collateralized basis over a similar term, an amount equal to the lease payment in a similar economic environment. Or for non-public and not-for-profit entities, you can use the risk-free rate, like the U.S. Treasury yield rate on the lease commencement date for new leases or on the date of adoption for existing leases for a period similar to the lease term. Again, I just want to reiterate that if the lease has a rate implicit, then you have to use that one. And also note that the risk-free rate is probably going to be at a lower rate than what would be in your lease contract, and that's going to yield a higher liability. A finance lease. So this is going to be very similar to the capital lease criteria under topic 840, the own standard. So lease transfer ownership of the underlying asset to the lessee by the end of the lease term. The lease grants the lessee an option to purchase the asset, and you're reasonably certain to exercise that. The lease term is for the major part of the remaining economic life of the underlying asset. That's that 75% rule that most of us are probably used to. And even though the new standard doesn't specify the 75% rule, many people are still using that just to stay consistent. The present value of the sum of the lease payment, any residual value guaranteed by the lessee is not already reflected in the lease payments, equals or exceeds substantially all of the fair value of that underlying asset. Again, that's that 90% rule we're all used to. And the last criteria is the underlying asset is of such a specialized nature that it's expected to have no alternative use to the lessor at the end of the lease term. And if none of these criteria is met, then you're going to treat it as an operating lease. As we go into our transition, we have two different options for transition methods, the full retrospective and modified retrospective. With the full retrospective for comparative financials, both years are going to be adjusted. And with the modified retrospective, your comparative financials, the balance sheet's not going to look comparative, so you wouldn't have the ROU asset or lease liability reported in the prior year. FASB is offering a few shortcuts in the application of recording leases under the new standard, providing lessees a practical implementation process. So the first practical expedient must be elected as a package. You can't do these individually. And for existing leases, you need not to reassess whether any contracts contain a lease. This relieves the organization from the burden of having to determine whether leases are included in existing or expired contracts at that transition date. You need not to reassess the lease classification, meaning if all prior leases were classified as an operating lease under the old standard, you would still classify those as an operating lease under the new standard. And same thing, if all existing leases were capital leases under the old standard, they'll be finance leases under the new standard. You need not to reassess the initial direct costs. So any costs that would have been avoided if the organization didn't enter the agreement. The next practical expedients may be elected individually. You can use hindsight in determining the lease term and assessment of the ROU asset impairment. So this allows lessees to look back at other factors when determining the lease term, such as options to buy, terminate, or extend a lease, and reassess on a go-forward basis at the time of application. So if you're in year 9 of your lease and you know you're renewing for another 5 years, this allows you to save time instead of reevaluating again at a later date. For non-public entities, again, you may use that risk-free rate that we've talked about. Again, however, you must use the implicit rate if it's readily determinable. And the third practical expedient that you may elect is to account for each lease component and its related non-lease component as a single lease component. And this election must be made by class of underlying assets. And a great example of this is a lease for a printer that might have an ink component. You can treat that as a single lease component. Accounting policies your organization will likely be adopting. There's a short-term lease. Again, if you elect this policy, then short-term leases with less than 12 months, it does not apply for topic 842, and you would just recognize those lease payments over a straight line basis over the lease term. There's the risk-free rate accounting policy. Again, you can elect to use the risk-free rate if the implicit rate is not readily determinable. And again, the single lease component treatment. You can elect this policy if you do not separate non-lease components from lease components for a given class of assets, and you would treat them as a single lease component. And these are new policies that you'll likely disclose in your financial statements. All right, we're going to start talking about the lease liability and the new ROU asset. So lease liability components for a finance lease. This is your present value of the carrying amount of lease assets and the capital lease obligation. And the lease liability components of an operating lease is the present value of remaining lease payments and the residual value guarantees. And that's the guarantee made to the lessor that the value of the underlying asset will be at least a specified amount at the end of the lease term. The present value calculation inputs. The period is going to be your lease term, the commencement to the termination date. And again, make sure you consider whether the option to extend or terminate a lease is reasonably certain to be exercised. The rate, the implicit incremental borrowing or risk-free rate, just another reminder, the implicit rate should be used before any other rate if it's readily determinable. And you're to use the rate at the later of the earliest period presented or the lease commencement date unless you're performing a remeasurement of the lease liability. If you elect the risk-free rate, you should use a period comparable to that of the lease term. And the lease payments is going to be your remaining fixed rental payment less any lease incentives paid or payable to the lessee. Make sure you also consider those variable payments, the options to purchase the asset, extend the lease, terminate the lease, termination penalties, and any other fees, and those residual value guarantees. The right of use asset, for the operating lease, it should be equal to the lease liability plus minus any lease-related balances that exist on the adoption date. So here's a little calculation for the operating lease liability, or for the asset, it's going to be the liability plus the unamortized initial direct costs plus any prepaid lease payments less your prior year deferred rent, less any remaining balance of the lease incentives, less any impairment of the ROU asset, and less any carry amount of topic 420 exit disposal obligations.
Hey, Sally, I'm going to launch the first poll here. So if you are interested in CPE, please take a moment to respond to the poll on the screen or in the chat box. I'll have the poll up for about 30 seconds.
All right, hope everyone can get that poll in. And we will keep on going. So the right of use asset for an operating lease. The lease incentives include payments made to or behalf of the lessee. So these lease incentives may include your rent abatement, any payments made to on behalf of the lessee, for example, your leasehold improvements. Under the new standard, if paid upfront, then the leasehold improvements are treated as lease incentives. And this will reduce your ROU asset, assuming the improvements are the lessee's assets. If the allowance is not yet received, the lease liability will also be reduced by the future minimum lease payments. If leasehold improvements are already on your books, then they're going to stay on your books. There's no need to remove them after you adopt 842.
I'm going to jump in for this one too.
Okay.
Just to clarify too, when we're talking about tenant allowances, leasehold improvements, there are kind of two parts of this transaction. You have the asset side, so the amount that you are capitalizing, your leasehold improvements, and you also have the liability side, so any tenant allowances that are sitting on your books. So when we're talking about adopting 842, if the payment was made up front and the asset belongs to the lessee, the amount that we're going to remove from the books is going to be that liability side, and that's going to go into your right of use asset. But as far as the capitalized leasehold improvement asset goes, that's going to remain on your books. And when I get to my section, we're going to go through an example where we actually look at this for an existing operating lease. So you can hopefully see this in action, but I just know that we received questions about that. And so I wanted just to clarify that point and that there's kind of two parts to that.
Great, thanks, Kathleen. All right, how are we going to calculate the right of use asset for a finance lease? This is going to be your finance lease liability plus any unamortized initial direct cost. And again, if you elect that package for practical expedience, then you do not need to reassess the initial direct cost for any existing leases. Your lease population. If the package of practical expedients are elected, then your population of existing leases will generally be limited to the leases that have been included in rent expense and disclosed in your lease footnotes in the year prior to adoption. Any new contracts, service agreements, or maintenance agreements entered into after the adoption date should be reviewed for any embedded leases. And if that package of practical expedients is not elected, then your population will be the existing leases that have been included in rent expense and disclosed in the lease footnotes in the prior year. And any new and existing contracts, service agreements, maintenance agreements will be reviewed for any embedded leases, even if entered into prior to adoption. I'll turn it over to Kathleen here to start walking us through the implementation steps.
Yeah, so Sally has brought us through a lot of good general information, some important definitions, and then the components of our right of use asset and our lease liability. So what I'm going to try to do now is take all of those elements and put it into 6 steps for implementation. After I walk through these 6 steps, we'll actually look at an example together. We'll go through an Excel spreadsheet for an existing lease, where we'll see how to calculate the lease liability, how to calculate your right of use asset, how to build the amortization schedules, and then post some of those journal entries. So we'll hope to answer, for those existing leases, you might have balances that are already on your books, right? You might have security deposit that's sitting on your balance sheet. Maybe you have some deferred rent. What do you do with those balances? How do they come off your books? And what's the other side of that entry? And we'll also talk through that leasehold improvement tenant allowance situation as well. So first, we can start with our 6 steps for implementation. The first step is going to be to determine if the contract meets the definition of the lease. And that's just straight from, what Sally presented on. It has to have these kind of 4 components. So the lessee has the right to control an identified asset for a period of time in exchange for consideration. If it meets those, then it meets the definition of a lease and you record. Step 2, you will identify if you have an operating or a finance lease. Remember that if you elect that practical expedient package, then you can just roll forward your classifications from the old standard to the new standard. So if it was an operating lease under the old standard, it will be considered an operating lease under the new standard. If it was a capital lease over in the old standard, it will be a finance lease now. Step 3, determine the non-cancelable lease term. I actually say start date to termination date. And then you also want to make sure when you're thinking about the termination date, to think about any options to extend or to terminate the lease. So if the lessee is reasonably certain to exercise those options, you want to make sure you're including that in your full lease term. If not reasonably certain to exercise, then of course do not include them. Step 4, you will determine your discount rate. Remember to use the implicit rate first. If readily determinable, we find that most of the time it's not readily determinable, so you can choose your incremental borrowing rate or your risk-free rate for non-public entities. And also, if you do use the risk-free rate, just a reminder to elect that and disclose that in your financial statements. Step 5, you will identify remaining lease payments, lease incentives, and other components of your right of use asset and lease liability. So I know Sally wrote out all the components of the right of use asset. I think that that's a good tool to kind of reference. You can see everything that's included in your right of use asset. Step 6, you will then calculate your lease liability, your right of use asset, and your amortization schedules. From there, once you have your amortization schedules, it's going to be really easy to post your journal entries because really you're just taking amounts from your amortization schedule and plugging it in really to the journal entries. One thing I wanted to note too is, and we'll go over this too in a later slide, but of course there are differences between your operating leases and your finance leases. And one of the biggest differences is for operating leases, you're just going to have a single lease cost. So it's just going to be one expense line item, usually called lease expense. But for your finance leases, you will have your interest expense and your amortization expense, and they're going to be broken out. So just kind of emphasizing for an operating lease, you're never going to see amortization expense and you're never going to see interest expense, in your journal entries. So I'm going to stop sharing for a second. I'm going to share an Excel file and we'll go through an example for an existing lease. Joe, this might be a good time to launch a poll as well, if you have it available.
Yeah, let me go ahead and do that, Kathleen. That's a great idea. All right, it should be launched now.
Okay. So while you're answering that, I will start on this example. Hopefully you all can see the Excel file. Sally, are we good?
You're good.
Okay. All right. So this is an example. We're going to walk through those 6 steps as I just mentioned, and this is going to be for an existing lease. We had some questions to go over an existing lease as opposed to a new lease that just perfectly starts on 1/1/2022. So in this case, I'll read through the facts first, and then we'll go through the 6 steps and calculate it all together. The facts of this are that you have a nonprofit organization that has a 5-year operating lease for office space that started on 1/1/2020. They have remaining annual lease payments for years 3 through 5 of $50,000, and it escalates at 5% annually during the remaining lease term. The lessee, they also have an option to extend the lease by 5 years. And if they do, the annual lease payments will be $70,000 per year, and they will increase 3% annually. It is at least reasonably certain that the lessee will not exercise the option to extend the lease. The risk-free rate is 2%, and they also currently have a security deposit on their balance sheet of $10,000 that they paid on execution of the lease agreement in 2020. And then at 1/1/2022, so as they're adopting, they also have deferred rent on the books and a tenant allowance on the books. So deferred rent is $50,000 and your tenant allowance is $30,000. The lessee also has capitalized leasehold improvements of $217,000. So that's the asset. So if we'll walk through the 6 steps. The first step, and if you want to participate in the chat, feel free to do that too for some of these steps that we'll walk through. Step 1, do we have a contract? So right to control an identified asset for over a time period in exchange for consideration. I think we meet all those definitions. You have office space, the consideration is the rental payments, and of course it's over a period of time. So that one is pretty straightforward. Yes, we do. Step 2 is pretty easy too, because we have a operating lease and that's just stated in the first line. So we can breeze through that one in this example. The lease term, so the start date for this is actually going to be the initial application date. So for this organization is 1/1/2022. So we'll use that date. This date is important because we're going to use it for the measurement period and in our calculation. So in our present value calculation for our lease payments. For this next question, if you guys want to write in the chat what you think, should we use the extended term? So that talks about how the lessee has an option to extend for 5 years. And then it talks about the payments for under those 5 years will be $70,000 and it'll increase annually at 3%. I'm seeing some no's in the chat. I think the key here is the sentence afterwards that says, it is at least reasonably certain that the lessee will not exercise that option. So the answer for that is do not include. In that case, because we're not using the extended period, our end date is just going to be when the lease terminates. So 5 years after 1/1/2020 is 12/31/2024. Step 4, we will determine our discount rate. And for this case, it's a risk-free rate at adoption of 2%. And then step 5 is where we're going to identify all of those components. So our lease payments, any lease incentives, and then the components of our right of use asset. So in this case, the organization had a security deposit of $10,000. They had remaining deferred rent of $50,000 and remaining tenant allowance of $30,000. And then we also have the lease payments, $50,000 escalating at 5% per year, which we'll look at below. You can see the calculation. Step 6, we're going to calculate the lease liability, the asset, and the amortization schedules. And from there, we'll book the journal entry at date of adoption, and then we'll look at what the what other journal entries might look like. So how your how to reduce your lease liability over the years and your right of use asset. Okay, so the first step for step 6 is to calculate our lease liability, which we'll do here. We have years 1 through 5, that's just the term of the lease, but we are in year 3 currently. So all we're going to do is first take the lease payments as specified in the agreement, which was $50,000, and that increases at 5% per year. So that's all that I've done here, and add that up. You'll get $157,625. From there, we can calculate our present value of these lease payments. And this is what I've done in this column. So all this 49 is the $50,000 payment discounted for one period at 2%. And then the $50,461 is $52,500 discounted for 2 periods at 2%, so on and so forth. There are tools out there to calculate your present value of your lease payments. For this, though, it's pretty straightforward, so I just used the present value formula that's provided in Excel. So once you calculate your present value of lease payments, you can add that all up, and we get $151,426. That is our lease liability that we're going to record. If you remember this number, we can calculate our right of use asset next. And we start first with that lease liability that we just calculated. Once we have the lease liability, we can add or remove all of those remaining balances that are on our books. So all I did here was I just looked at the slide that Sally presented on that showed all the components of the right of use asset, and I plugged in what this nonprofit has. So they had the security deposit of $10,000, they had some deferred rent of $50,000, and then they had those lease incentives, the tenant allowance liability side of $30,000. So once you do that, you can calculate your right of use asset at $81,426. The last step, as far as calculation goes, for this part, is calculating your lease expense. If you remember too, I talked about you have a single lease cost for operating leases. The other part of that is it will be expensed on a straight line basis. So to calculate those the lease expense, you will start first with $157,625, which are just your lease payments, your remaining lease payments per your lease agreement. And then you do the same thing that you did with the right of use asset. You add in the security deposit, remove the deferred rent, and remove your tenant allowance. We get remaining lease costs of $87,625, and we divide it by 3 years, which is the remaining term of the lease, to straight line it. So we get straight line lease expense of $29,208 per year. So from here, we're going to now calculate our amortization schedules, and then we can post our journal entries. So the first step for lease liability amortization, we start with our beginning balance as we calculated up here. And the components of your lease liability amortization schedule is just going to be the lease payments that you make, which obviously reduce your liability, and then increase for interest on your liability. So this 104 is just your beginning balance of $151,426 less $50,000, add in 3029, and so on and so forth. So you can see at the end of year 3, our lease liability is 0. You scroll over to our right of use asset. You start with the beginning balance, just as we calculated. And actually, your reduction to your right of use asset for an operating lease is kind of a plugged number. I know that's a bad word in accounting, but it is a plugged number. The reduction to your right of use asset is going to be the difference between your straight line lease expense, just as we calculated up here, and the interest on your lease liability. So I kind of had a calculation up here. You can see 26,108 is the difference between this number and this 3,000 number. So then you get 55,000 and so on and so forth. And then at the end of year 3, your right of use asset is 0. Lease expense is easy. It's just straight lined over the remaining lease term. Okay, so what do the journal entries look like? I've written them out for your adoption date, and then throughout the year, what are your entries going to look like? So if you remember, this is an existing lease. This is for an existing lease. So this organization already had security deposit, deferred rent, and a tenant allowance on the books. They also had a leasehold improvement, which we'll get to when we get back to the slides. But the first step for adoption is to remove those balances. So these first 3 entries are doing just that. So if we had the asset on the books, it was a debit balance, so we credit it to remove it, and so on and so forth. All of these components get wrapped up into your right of use asset, and so you just you recognize your right of use asset and your lease liability just as we calculated above. So that's the first entry. The second entry for year 1, you will make these throughout the year. In my example, we're just showing it on an annual basis, but you can choose to do it monthly, quarterly, whatever you feel is right. So this entry is going to look pretty similar every year as far as the accounts that you're hitting. Of course, the amounts will change. So your lease expense, remember, single lease cost for an operating lease is going to be the 29,208. That's the straight line amount that we calculated. And then you record your reduction to your lease liability and your right of use asset, just as we've calculated up here. So the 26,180, 26,180, and then the difference between 151 and 104 will be the reduction to your lease liability. And then you, of course, have a cash payment that's going out for year 1. It was 50,000, just comes from your lease agreement. It's the same thing for year 2 and year 3 with different numbers. So your straight line lease expense, your reduction to your lease liability, your reduction to your right of use asset, and then the cash payment for your lease payment. Okay. So that's kind of an example for an existing lease. And I will go back to the slides at this point.
All right, Kathleen, I'm going to launch the third poll since we're in transition.
Okay.
I'll keep this one up for about 30 seconds.
Take a sip of water real quick. Okay. So we went over these journal entries in that Excel example that we just went over, but I included them in these slides so you can have them for reference. Looking at, for existing leases, what the adoption journal entry might look like. So removing those existing balances and then recognizing your right of use asset and your lease liability. And then the second entry is what your standard entries are going to look like throughout the rest of the lease term. So recognizing your single lease cost, your lease liability, your right of use asset, and the cash going out. This is also part of the example that we just went over. I thought it was maybe helpful to see a visual example of what the balance sheet might look like just before adoption and then after we post those journal entries. So on the left-hand side, you can see everything in red are related to that existing lease that we were talking about. So you have the 217 of leasehold improvements, you have a security deposit, deferred rent, and a tenant allowance. After you post the journal entries, you can see on the right side, we now have a right of use asset in blue of 81,426. That's going to agree exactly to what we calculated in our example. Also in blue, you have your lease liability, a new account of 151,426. Again, it agrees exactly to what we calculated in that example. You'll notice that the leasehold improvements are still on the books at 217, and then your security deposit, deferred rent, and tenant allowance are now all removed. They are all zero balances. All have zero balances. All right, so I wanted to point out some differences between the operating lease and the finance lease, since we didn't really have we didn't really go through an example of a finance lease. So what I did was create amortization schedules for both of those, for both the operating and the finance lease. So across the top, we have the lease liability for both an operating and finance lease in the orange, yellow color. In the middle, in green, you have the right of use asset for an operating lease. And then all the way to the right in blue, you have the right of use asset for a finance lease. Then below, we have two journal entries. On the left is for the operating lease, and then on the right is for the finance lease. Some of the differences that you might notice. So for the operating lease, you have straight line lease costs, and it's a single lease expense, and it's going to be, the same every year. But under your finance lease, you're going to have amortization expense and interest expense. So they're broken out separately. And you'll notice too that that amount, it's not straight line every year. It's going to be different, but it also doesn't agree, obviously, to the lease expense per your operating lease, right? The number that will be straight lined under the finance lease is your amortization on your right of use asset. I think those are all the things that I wanted to point out. Also, maybe too, that the lease liability is calculated the same, but the differences are going to be for your right of use asset accounts. All right, in this next section, we're going to go over presentation on your financial statements. So we'll look at the balance sheet, the income statement, and the cash flow statement. So for your balance sheet, you want to make sure that you recognize on separate line items your finance lease right of use asset separately from your operating right of use asset. Same thing for your liability. You don't want to put them together. We also received a question in the registration list about if you can combine your right of use asset with your lease liability. Hopefully after the example, you can see why you wouldn't want to do that and why you can't do that, how you have to kind of track them separately. So make sure you're doing that on your balance sheet. If you have a classified balance sheet, you have to report your current separately from your non-current balances. So make sure you're breaking those out. And then in the fourth bullet talks about how you can actually disclose this information, your right of use asset and your lease liability, in the notes to your financial statement instead of showing on the face of your financial statement. But you just need to identify, which line item on your balance sheet are these accounts included in account balances. For the income statement, you will have, we kind of discussed this already, for your finance lease, you will have interest expense and amortization expense. And those can just be included with other amortization and interest expense that you might already be recording for other types. And then for your operating lease, you'll have your single lease cost that you'll show. And that's allocated over the lease term on a straight line basis, which we kind of already touched on too. For your cash flows, I've broken this out based on the type of activity. So in the table, you'll see your operating activities on the left-hand side, investing activities in the middle, and then your financing activities on the right side. So for your finance leases, any interest payments are considered operating activities, but any principal portion of the payments will be financing activities. For your operating lease, your single lease costs are operating activities, but any purchases of assets will be in your investing activities. And that's kind of what we know. When we purchase fixed assets, we know that goes in the investing activity. So it's kind of similar there. Any variable lease payments and short-term lease payments will be operating activities. The other thing for the cash flows is we want to make sure we're disclosing at the bottom any non-cash investing and financing activities. Okay, so for disclosures, there's a lot of information. I tried to break it up into 3 separate buckets, I guess, if you will. I think the biggest thing is just making sure you're disclosing the amount, timing, and cash flows for your leases. So the 3 buckets that I broke it out into are your just general lease information. Second bucket is significant judgments. And the third bucket is amounts recognized. So we'll go through those 3 and I'll go into more detail a little bit for those 3 buckets. First one, for lease information, make sure you're disclosing general information about your leases. Any options to extend or terminate the lease, make sure you are including that as well. And if you have any significant leases that have not commenced, make sure that you're disclosing that. There are other ones listed on here that you can reference when you're working on your disclosures, but it's a lot of information, so I won't go through each one. For significant judgments, make sure you're disclosing the discount rate and any practical expedients that were elected. And of course, whether the contract contains a lease. Amounts recognized. So there's a lot here too. Your finance costs, so your amortization and interest expense, you'll disclose those amounts. For the operating leases, you'll disclose your single lease cost. Any short-term lease costs you'll disclose, and then any variable lease costs you also disclose. Sublease income, make sure that you're disclosing that. And then at the bottom, it talks about weighted average of your remaining lease term and your weighted average discount rate. You want to make sure you're separating that out. If you have finance and operating leases, those will need to be disclosed separately. It's pretty easy if you have one lease because it's just that lease term and it's just that discount rate, but the calculation becomes more complicated when you have multiple leases, of course, because you have to take the weighted average. If you have lease transactions between related parties, you want to make sure you're disclosing that. And then the last one is our maturity analysis. I think instead of reading this long paragraph, it's easier to see in a visual example. So I've kind of developed that. And this is probably something, it's similar to what we've kind of been disclosing in the past as far as minimum lease payments go, but with a little bit of change. So we will show the first 5 years of our minimum lease payments and then thereafter, however many years. And we come down to our total undiscounted minimum lease payments of $11 million. We then take the discount to present value, $984,681, and then we come down to our total either operating or finance lease liability of $10 million. And that $10 million should agree to the amount that's listed on your balance sheet as well. This is going to agree to the lease liability.
Kathleen, I'm going to launch the final poll here.
Mm-hmm. All right. I think we're doing really good on time. This is the final slide that I need to present on, and I'll shamelessly plug upcoming events that we have at CBM if you're interested in post-retirement planning or the Inflation Reduction Act. I know we have a lot of good presentations upcoming, so you think it'll be helpful to your organization, of course, feel free to join these complimentary events. And then if you have any questions too, you can feel free to reach out to Sally and I. And we hope that, this presentation was helpful. We tried to, like we said at the top of the hour, we tried to incorporate all the questions we received ahead of time in our slides. So hopefully some of your questions were answered.
I just want to thank Sally and Kathleen for walking us through this. It's very complex and challenging, and we appreciate you laying out in a way that was much more understandable. And thanks for all who attended today. Really appreciate your time, and have a great day.
Thank you.
Thank you.